Let's get to our closing bell exchange for this Friday. Tom Lydon from ETFtrends.com is with us. So is Peter Costa from Empire Executions. He's here with us at the big board, and Rick Santelli is there in Chicago, the land of R. Bob and L. Bob and all those Bobs. So Peter Costa, you're the lucky one that gets to explain to us, make sense of this volatile week. It's kind of quiet today, was a little bit yesterday, but very volatile early in the week. What's going on?
It was obviously all about China, and I think we had mentioned that when everyone was worried about Greece, and I think that I might have been one of the few guys on the air that had said that a bigger issue is China. It's not Greece, it's China, and I think it came through this week. You know, you'll see the yuan raised up a little bit this morning. You know, things are starting to stabilize there, which you would expect, and I think that, you know, markets always go to equilibrium, and I think that the dollar-yuan trade type of thing will go to equilibrium as well. So I think that that part of the equation is slowly going to be mitigated, and I think that's what happened yesterday and today.
Tom, what are you watching in this market? How much of an impact is China relative to oil having on where equities go from here?
Well, it absolutely is, and I think what Peter was saying is 100% right. We've been looking at flows in the ETF marketplace, and a lot of smart money has been coming into China-related ETFs off this recent correction. Most importantly, the Deutsche X-Trackers A-Shares ETF, ASHR, has seen a lot of money. But the key is, and I think the magic bullet is, there's a company, CSOP, that's going to partner with MSCI to come up with a A-Shares currency hedged ETF. So this type of ETF will make money when A-Share market goes up and the yuan goes down. So I think that's perfect, as we saw Bob Pisani in the last segment talking about the money that's going into currency hedge ETFs. Very popular, as currencies really are becoming an asset class for investors.
Yeah. Hey, Rick, of the markets you follow after this kind of week, what's your takeaway? What's the message to you right now?
Well, I think the takeaway is stick with foreign exchange. I find it so fascinating. The dollar index got walloped this week, down over a penny, because the euro is up large. But the yen is close to unchanged against the dollar, and of course the dollar is king, at least for the week, against the renminbi or the yuan. So there's a lot of cross flows here, which really does underscore trying to get a handle on this kind of recalibration going on is difficult when you're looking at the primary sources, just the foreign exchange markets. Trying to handicap this as it filters through on the price of various goods being traded around the globe is something that's going to be with us for a while. And I still contend that, you know, as Peter was talking about, oh, the markets will get back to normal and they'll digest this. I don't disagree. But, you know, we still don't acknowledge that the room's filled with natural gas and we've gotten used to it. So what he's saying is the markets are going to get used to the manipulation by the Chinese under the header that it's normalization and liberalization, but we all know that the timing speaks volumes of why they did it. And then you rise to the macro issue. They need to do it. They need to continue to put that extra chicken on the table to keep those they moved into the middle class working and happy in a society that isn't going to have social backlash. And I think these issues with China are going to be around for a while. The second market I want to reference is, of course, the long end of the curve. 10-year and 30-year yields are up slightly on the week, and the 30-year did hold its settlement for 2014. So even though I acknowledge weakness brings rates down, we might have hit a point where that dynamic until the September meeting is sort of glide path about where it is now.
And meanwhile, Peter, the data wasn't that bad. Industrial production in the U.S. this morning, the PPI was somewhat firm. Is that why the market here, the interest rates are holding up a little bit?
I think so. You know, and I don't think it was unexpected. And, you know, but this has been, we've been in a period probably for the last 5 or 6 months where we've had, you know, you'll have one day of some positive economic news, and then, you know, come Monday there might be something that's on the negative side. So it's that, you know, that back and forth of what's good, what's bad. You know, the Fed is still looking at all of this, and they still are not getting, I don't think they're getting a true reading on the economy yet. And I think we're probably going to be in this phase of good news, bad news for several more months going forward. So to me, you know, we had talked about when we think the Fed is going to raise rates. I think it's going to be next year. I don't think there's anything in there. I think they get the good news, which makes them want to do something, and then there's bad news right behind it. And then they say, well, you know what, let's back away from that idea for a little bit and see what goes down next month.
By the way, very quickly, Tom, before we go, we got word late today that mostly outflows out of equity funds in this country, and most of that was out of actively managed funds, while money was going into passively managed index funds. So what do you make of what the average U.S. investor is doing with the stock market right now?
Yeah, Bill, you're playing my tune. I tell you, it's more of the same. It's transparency, it's low cost, it's tax efficiency, and it's not paying a manager who's not performing. And unfortunately, there are a lot of big mutual fund companies who've made billions of dollars on Wall Street that now the gig is up. Money is shifting over to index investing because investors have more trust in their type of management. Now, again, active management in a few cases, there's some good managers out there, and we want to make sure we recommend that. But for the most part, if you're not performing along with your benchmarks, you can't command the high fees that some of them are getting today.
Yeah,
we'll ask John Calamos next hour. Got him on joining the program, hedge fund manager.
Thanks, guys. Have a good weekend.
Thank you.
See you later.